Top Biden officials panic. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the Biden administration is in crisis as a major U.S. city is on the brink of collapse. And what I want you to understand is what's happening in this city is going to spread to every major city across the country in a matter of months. And for the current administration that's been pinning its hope of re-election on the strength of the U.S. economy and the labor market, well, as you're about to find out, this is the worst possible news they could face. Now let's head over to Zero Hedge, where we picked today's story up with a headline as the Chicago PMI unexpectedly craters to depression levels. And this is a critical problem for the administration, because if you see a major city start to crumble, what it means is that underneath the economy that everybody is claiming is strong and robust, well, it tells us it's far weaker than anyone thinks. And as you're about to see, is going to spread to cities all across the country. And after unexpectedly slumping last month to 37.9, the Chicago Purchasing Managers Index cratered even more unexpectedly in May. Now keep in mind, many people thought this was going to rebound when it defied hopes, instead even tumbled more, sliding to a cycle low of 35.4. And this is depression level data. We talked about Germany's manufacturing sector being in depression. Well, now we're looking at Chicago, and this is a major problem because, well, it has a lot to do with Illinois and the Democratic Party. And this was not only below the lowest estimate, but staggering low. And to get a sense of just how low, the last two times it printed here was during the peak of COVID and the global financial crisis. As you can see here, this is dangerous news. And at this point, we're in the early stages of a recession, suggesting that things are going to get far, far worse. And this, of course, means the economy there is indeed in a depression. And this is why there's panic among top officials, because if Chicago goes down, well, there's a big risk of losing Illinois, as you can see, which has been voting Democrat for many years. The next presidential election is a key state for the Biden administration. But looking at the report, and you start to understand the risks here from a political standpoint, it is all about the economy, because if we are indeed in a full-blown recession by the time the election hits, we know statistically the odds of a president being reelected for a second term, well, somewhere near zero. And here you can see the business barometer fell at a faster pace, signaling contraction as new orders fell at a faster pace. Again, contraction, employment, signaling contraction. And this is a major issue because, we think about when there's prosperity and people go to the polls, they tend to vote with their hearts. But when they're struggling, they tend to vote with their wallets. This is bad news, of course, for the current administration. Inventories falling at a faster pace. Supplier deliveries falling at a faster pace. How about this? Production fell at a slower pace. Contraction after contraction. Here's the big one. Order backlogs falling at a faster pace. But what did go up? Well, that was prices paid. And that, of course, means just what you're thinking, that we're in a dangerous place. If economic activity is indeed crashing to depression level space, well, what does that mean if prices are rising? Well, if you're thinking we're facing a stagflationary depression, you've got it right. And when we look at, of course, the manufacturing sector and why this purchasing managers indices are so critical, here we can take a look at the Philly Fed. We don't have the Chicago PMI data in the St. Louis Fed database, but we do have the Philadelphia data. And what we can see is periods of manufacturing slowdown and even outright contraction when that blue line falls below the horizontal black line. We look at continued unemployment claims in red, and what do we see? Slowdowns in manufacturing lead to rising unemployment. And you can note that this happens each and every time there's a slowdown in the manufacturing sector, because they're relatively quick to lay people off. And one of the problems for the economy is these are generally higher paying jobs in the services sector, and when their spending power goes away, well, it has massive repercussions for the economy. Here you can see now, looking at the Philly Fed data, which showing expansion, at least until we maybe see the next print. What this suggests based on Chicago's data, they're deep into a depression, meaning the unemployment level there is about to go higher. And as Zero Hedge notes, this is not just a depression, but a stagflationary depression, which everything else now is going to hell, they claim, except prices, which keep on rising. Now, of course, we know that prices just do not rise if demand goes away, but they can can rise in the short term. You think about what's been impacting consumers. Well, that's been, of course, increases in auto and home insurance. Well, that's been affecting employers as well. They're being forced to raise prices, but how long can they do it? And while it's unclear what has prompted this unprecedented bearishness, maybe if there's a Boeing effect, one thing is certain: Goldman will have to come up with even more gold-seek surveys to explain the way of reality and tell us how purchasing managers should feel. And that means, of course, things there are getting worse. But I want you to know, do you live in the Chicago region? What's going on there? Weigh in the comments. Do you think we will be in a recession by the election? How are you going to see the future here? I'd love to know, because one thing that people should be excited about is when they see headlines like this, because remember, the market makes the news. The news doesn't make the market. In this case, silver's import set to jump as solar demand lifts prices. Many people wishing they would have bought. But here's the deal. We showed our subscribers right here that the machines had moved into a big short position after this rally, and price started moving against them. We said this is where you should be buying, and sure enough, those that did back on April 8th. Could you imagine? This trade has been on the books less than 1 month, and our subscribers are already realizing a near 12% return. How are they doing this? Because this is our CTA Timer Pro report that takes a look at the machine positioning. We run a historical overlay, and when price rallies against these machines, when they get short, we indicate that to our subscribers in our daily report. We show them videos, tell them how to trade it, and they make money. It's that simple. And here's the best part: you too can start making money. Start being ahead of the news. Check out the link in the description below for a 30-day free trial. Start trading, start making money, because if indeed we're in a stagflationary depression, you're going to want to take control of your investments. There will be opportunities. We'll show you those, because when we look at the consumer price index, we talk about stagflation. And what is that? It's a period of rising prices and rising unemployment. The problem is they don't last forever, because what I want you to see here is when you know the prices are rising and you see here continued unemployment claims rising, there's this recurring thing that shows on the chart, which is these gray bars on the vertical. What that means is recession. And what happens when the recession hit? Demand goes down, the consumer prices fall. Right now, we're kind of seeing what's called sticky inflation, at least from the political elites, suggesting it's not going to go down, but it indeed will, particularly as we see unemployment claims likely to rise. Of course, the official data is not validating that yet, but I think it's only a matter of time before we see that. And as we've noted, the robust economy, if you can call it that, love to know what you think. Is the economy indeed robust? Weigh in the comments. Can't shield Biden from blame for higher prices. That's true. Consumers often blame those at the top when they don't get what they want. The problem is presidents, as we know, have little control over what you pay at, of course, anything when you go to the store. As opinion poll after poll shows, strong majorities are unhappy with the economy and blaming President Joe Biden for it. Some of this is in the face of verifiable facts, as a Harris poll survey for The Guardian last month found that 55% think the economy is shrinking, 45%, 9% that is, think unemployment is at a 50-year high, not a low, and 49% think the benchmark S&P 500 is down for the year. It's a matter of fact that all these beliefs are wrong. And when indeed that is the case, people have noticed this is driving the economic negativity. A poll in 7 swing states conducted by the Cook Political Report found that only 6% of respondents named the stock market as the most important way to measure the economy, and only 13% picked low unemployment, and said 54% said it was cost of living. And this is something that people are going to take to the polls with them. They blame the president, with 59% saying the administration had the power to bring down prices. Well, there's good and bad news. The administration is indeed going to bring down prices when we hit a recession, most likely by the time the elections get here. The problem is there'll be so many people on the unemployment line, they will be not worried about prices. They're going to be worried about their income. And there's little way for Biden, because the inflation is causing pain, afflicts the prices over which politicians and central bankers have the least control. Well, at least the Fed tells us they do, but we know the truth. Short of using taxpayer money on subsidies, there's nothing the president can do about food prices. As for oil, driven late by geopolitical events, Biden has already used one of his most obvious weapons, the release of barrels from the Strategic Petroleum Reserve. And as we noted, that absolutely had a very minimal effect on the market, draining, of course, the gasoline reserves in the Northwest West will have virtually minimal impact on prices. But what do you think? Does the president have a lot of power in this case? Weigh in the comments. What do you think? Because the Fed's favorite inflation gain cools, telling us that what's happening in Chicago is going to spread all across the country as spending now unexpectedly drops. Well, it's not unexpected to us because we know that in periods where you see rising unemployment, high prices, that consumers cut back on spending. And there's another factor here has to do with, of course, incomes, as inflation-adjusted consumer spending unexpectedly fell 0.1%, dragged down by a decrease in outlays for goods and softer services spending. Remember, everyone said the services sector was going to drive the economy. Well, it doesn't. It follows the manufacturing sector as wage growth, the primary fuel for demand, has moderated, something that we said would likely happen. Remember, the political elites have been telling us everybody's getting ahead. They're getting ahead. We said, no, not so fast. And sure enough, when we look at the consumer price index, here shown in blue against total compensation, this is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, both shown on a year-over-year rate of change. What we can note is right now the data suggests the average consumer is indeed ahead of consumer prices, but there's something missing because spending is dropping, and what's not being captured in this monthly data series is what's happening in between, which is hours are getting cut. We're seeing this happen in every single survey report. Hours cut, hours cut, hours cut. This is not a good sign. This means, of course, as we know, consumers do not have the spending power to keep up with inflation, to keep the economy running. And when we look at household demand, we note that it's getting worse. And while fueled by steady job and income growth, it is showing signs of cooling. The BA's report showed inflation-adjusted outlays for services rose a scant 0.1%. The smallest gain from August. Spending on merchandise decreased 0.4% last month, which matches what we're hearing from retailers like Kohl's, who said they can't even sell stuff that's on clearance at deep discounts. That's telling you consumers are indeed tapped out. Good outlays were restrained by declines in gasoline and vehicle purchases, while healthcare spending supported outlays for services. Other categories such as restaurant meals, recreation, and transportation decreased during the month. And from some of my contacts here where I'm at, that is being validated. We have a couple busy weeks here, and yet the restaurant staff around here are telling us that they are not that busy. Again, all a sign the economy is indeed slowing at the wrong time. And again, for, of course, top Biden officials, this is the worst possible news they could be facing. And looking ahead, with household debt hitting a record, consumer confidence generally trending lower, and interest rates at two-decade high, it remains to see what extent consumers will continue powering the economy. No, it doesn't remain to be seen. We already know, and that's the issue here. Consumers are now facing the reality they can't afford these higher prices. They're loaded up. Their credit cards are maxed out. They're even running behind on their buy now, pay later loans that they took out earlier this year. They're finding out they don't have the spending power. They're not getting the hours they want at work. We know for a fact their spending is going to drop, and so too is the economy. And while demand for workers is still healthy, at least, well, based on the headline data, the pace of wage growth, and we noted this was going to happen, is cooling. Overall incomes rose 0.3% in April as wages and salaries advanced 0.2%, the smallest gain in 5 months, which is telling us what we've been warning, that wage growth is heading back to pre-pandemic levels. This is not what, of course, employers want. They need their wages to keep pace. It's not working at all. In fact, the biggest problem employees are facing right now is gasoline prices. You look at total compensation shown in red against gasoline prices, this form of dollars per gallon, and you can see when total compensation growth slows in red against rising gasoline prices, well, what happens? Usually we end up in a recession. You see that happening here going into the global financial crisis. Wages were slowing. Expenses were rising, meaning they could not afford the discretionary side of the economy. Next thing you know, we're in an all-out recession. We're seeing that happen now, and it's being validated again by companies like Walmart, McDonald's, Target, Burger King. They're all saying the same thing. and that is discretionary sales are declining. Consumers are going broke. They're out of money, and we see that in the report from last week as real or inflation-adjusted disposable income. The main support to consumer spending fell 0.1% in April, the second decline in the last 3 months. This means, of course, wages are not keeping up with inflation. The savings rate, get this, held at 3.6%, matching the lowest since the end of 2022, meaning, of course, consumers do not have a savings to back up their spending. At some point, they're going to prioritize building those savings accounts up. It's going to come along with a big cut in spending. That is what's going to trigger, of course, the economy to head into a recession. And we're even seeing it in the housing market here, where this headline is home buyers are starting to revolt over steep prices across the U.S. And this is exactly how stagflationary depressions end, when consumers realize they can't afford it and they stop spending. As house hunters of all kinds are being squeezed out of the market, sales of new homes, a bright spot for the inventory-constrained market, fell in April as contracts to purchase existing homes that month slumped to the lowest level in 4 years. The pullback is causing listings to accumulate rather than getting matched with buyers, something we warned would happen, because when you see builders have too much inventory, they have the margin to cut. They will cut. This will put pressure on the secondary market, and next year, prices at some point will come down. And you talk about timing. That is the key here. We're seeing the economy slow down at the worst possible time, because going into the summer months, this is where a lot of spending happens, and a lot of businesses are reliant to get on the summer months for their revenue, because they have virtually no business in the winter months. This is dangerous. Look at the housing market now. The spring selling season so far is definitely a disappointment. At the beginning of the year, I thought sales would increase. This from the chief economist for the National Association of Realtors. Well, maybe you should watch this show. We'll give him the heads up, as everything is kind of stagnated. It's frustrating for realtors because it's like we're being shut out. There's no work. And what no work means? Well, it means no income. It has gotten very flat. It has become much a buyer's market. Well, probably not as great as it will be. A lot of price reductions are starting to happen, as price growth could slow more broadly in the coming months. And this means, of course, any deceleration will likely be slow, given the demand from millennials. Well, here's the thing. If they don't have jobs, they're not buying homes, and their savings rate's pretty low. So when you put this all together, you can see why top officials in the Biden administration are starting to panic. You see a town like a city like Chicago start to go down, and it tells you just how fast this is going to spread across the country. And with a matter of 6 months to the election, it's going to be a dangerous game as they face an impossible challenge of trying to get reelected during a recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.